Your take on OPEC Plus agreement today?
I think, Prince Abdulaziz has pretty much been at this for a while. And I think you can see from the masterstroke that he played today, because he did manage to please the US, increase production by a little bit more than the monthly quota increases that had been going on for some time, and yet kept the group together, including keeping the Russians on his side, because essentially, he is bringing forward the deal, exactly as Jeff is saying. The end now is August instead of September. It's slightly more production. The reality is there's not a lot of spare capacity in the market other than Saudi and UAE anyways. So the volumes actually going to hit the market is going to be very, very minimal. We are expecting over the 2 months, July and August, only about 560,000 to come to the market, even though the headline quotas are going to be closer to like 1.29 million barrels per day.
Amrita, good to see you. So there's some symbolism here then that has been welcomed by the US, although we hear Jeff Curry and also your skepticism about how much difference it really makes. Does this take us towards, thinking of the politics of this, does it take us towards a Biden visit to Saudi Arabia? We know that that is set to take place now later on this month. And maybe there's more to come then. Maybe the Biden administration would want to achieve something from that visit. Can we look ahead to any change later?
I think that's the main question the market is asking right now, because clearly this is a precursor to that. I think Prince Abdulaziz has also been very clear in saying that, yes, look, the crude market is tight, but a lot of the tightness is coming from refined products and the lack of refineries. So even if they were to add more crude production, doesn't mean that gasoline and diesel prices will come down. So it does have some fundamental basis as to why they didn't change the deal significantly. And also, I think we still firmly believe that OPEC Plus and particularly Saudi Arabia want to continue with the group and come up potentially with a new agreement following the end of this one, because I think OPEC cohesion is still very, very important for them. So while, yes, I think this does lay the groundwork potentially for a Biden visit at the end of the month, yes, and maybe we could see some further increases from September onwards. Let's say as a group, instead of raising by 430,000 barrels per day, maybe the group adds a little bit more each month. Again, reality is it's going to be just those two countries that have the spare capacity, Saudi Arabia and UAE, marginal some elsewhere. So we're not going to really see a flood of oil in the market to begin with. So it doesn't really solve the deficit. But yes, it's going to be giving a nod to those US requests. I'm not sure that's going to necessarily solve the inflation problem for the Biden administration, though.
No, exactly. And that's what I was going to sort of ask on that, Amrita, because let's just pretend there just is magically more oil from Saudi Arabia. They get to 11, 12 million barrels of oil a day. They're like, yeah, totally, I can pump it and put it out into the world. Can the U.S. actually use it? Like, do we have enough refiners who can make the right products that can use the right kind of oil that Saudi Arabia has? Like, does it materially make a difference then to Biden's problem, which is how much it costs to fill up your tank of gas?
Not really, because refined products markets are far, far tighter than crude markets, because we've been shutting down refineries. We've closed about close to 3 million barrels per day of refining capacity since 2019. And the biggest change has been, I know you and I have talked about this, Alix, has been around China. China's changed its policy since 2021, really. It doesn't want to pollute its own economy and export products to the rest of the world. So it's been cutting back on how much it exports. And China still has 3 million barrels per day of excess refineries, but it's not running them. As a result of that, the market is extremely tight. I mean, US refineries are running flat out. There is just no more refineries to take the oil. Europe, for instance, has bigger struggles absorbing more Middle Eastern oil because it tends to be more sulfuric. So it's got more sulfur, it's more acidic, and European refining kit struggles to process that. So the quality mismatch is there, but probably more so for Europe than the US. We just don't have enough refining capacity.
Amrita, back up the supply chain and thinking about where prices are right now for a barrel of crude oil. We look at Brent at 116, we've got WTI at 115 or so, and both of those have been oscillating a lot based on the data we've received today and the input from OPEC Plus, of course. Given all of that, where do you put fair value of oil at this point?
I'd say prices are going to head higher from here, right? Like, yes, we've absorbed quote unquote relatively bearish news from OPEC. We don't see it as bearish because, again, these are minuscule volumes, barely make a dent to our balances, which are showing huge deficits in Q3. But sure, the markets absorb this. It's obviously worried about recessionary fears, whether it's in the US, whether it's in Europe. But China's opening up slowly but surely. I think that's going to be a huge boost to the market. Ultimately, we're looking at 1.5 million barrels per day of draws in Q3. That's an unsolvable balance. We just don't have that level of inventory to draw down. So the only way to balance this market has to be prices going up so that demand comes down.
Amrita, let's just also pretend that U.S. oil producers decide to just pump a ton. Does that solve any problems at this point?
The problem with them deciding to pump a ton is where are they going to get the materials from, raw materials, right? Steel, cement, labor. When I was over there a couple of months ago, every CEO was saying to me how Amazon is taking all the laborers from them. So there's some real shortages there. And oilfield services is the biggest constraint for U.S. production right now, regardless of shareholder pressure. So I think there's going to be some real challenges for the U.S. to overcome if it is to add any meaningful volume. Of course, production is growing. And the March numbers came out yesterday. And they were pretty decent. But, we have to see significant easing in oilfield service constraints before production can go, well towards the kind of pre-COVID levels.
Amrita, just briefly then, a tighter market over the summer, is that what we look ahead to? How much depends on China?
Quite a lot depends on China. And I think China is even more important for 2023 because that's when the supply tightness really rears its head because you've got the EU embargo kicking in by the end of the year. And that's potentially when, we are looking towards a US and European recession. But if China does open up and you actually see supply chain shortages ease, then the recession is not going to be as severe in the West. I think that's going to be the key. Then you can have a mild recession. And I think then prices can kind of continue to remain quite high for some time.